All right. Greetings and welcome to our Missing in Action webinar. Where is the V in LTV? When is hospitality asset value coming back? Sponsored by Sales Boost. We appreciate you all for attending and taking the time today. As you all are logging in, you can see on the screen our group of panelists, our facilitator and sponsor, whom we'll be introducing to you shortly. So thank you so much for joining. And so if I may, for those that have already logged in, we would love to see where you're logging in from in your chat feature. Go ahead and chat with us and say hello. Let us know you can hear audio. And we'd love to hear again where you're dialing in from. And that is in the chat feature at the bottom of your toolbar. Welcome everyone. Salt Lake City. Looks like, Greg, you have someone that says hello, Chris Balloon.
Jim Urlacher from Maine.
And when
Debbie Gutierrez.
When you do chat, make sure you select all panelists and attendees, everyone in the meeting. So that way everyone can see where you're dialing in from, not just the panelists today. We got Chicago in the house. Nicely done. Dexter Wood, Boston, Massachusetts. Welcome everyone. My name is Andrea Christofferson with Sales Boost. We are proud and honored to sponsor the webinar today. Our topic is incredibly important, focused on where's the V in LTV? Is it missing in action? And we'll address the question, when is hospitality asset value coming back? So thank you again for joining. We'll get started in just about another minute, allowing our attendees to log in. And if you haven't heard me before, please chat with us, selecting everyone in the meeting, and let us know where you're dialing in from. We'd love to hear from you. Boulder, Colorado. New York City.
Hi, Kathy Lee.
Yeah.
Calvin from Spokane, Washington. Or Spokane.
Malibu, California.
Jack from Denver.
Welcome everyone. All
Kevin,
right.
Kevin, call me after this. I haven't seen you in a decade. Maybe two.
Good afternoon. Thank you for joining everyone.
Hey, Megan Gabriel and the team in Cincinnati. Great to have you join us.
And Rob Heller from NYC is joining us again. Thank you. We're going to go ahead and start today. We have so much to cover, and we're going to go through some housekeeping notes to ensure that everybody has an optimal experience first. So again, my name is Andrea Christofferson with Sales Boost. We are so proud and honored to host the webinar today. We have a superior expert panel, just first class panelists that will lead the discussion and address this question, when is hospitality asset value coming back? So it should be engaging, timely, informative, and most importantly, you're hearing from experts that will give extreme great advice. Helpful tips. So a couple of things to maximize your screen. We want to make sure that you are viewing in gallery view or side by side. And so in your toolbar, we would recommend that you select gallery. And that way you can see all of the panelists together as well as what's on the screen. You also want to maximize your screen. You can do that on the upper right-hand corner. Be sure to turn up your volume. That's incredibly important. We want to make sure you can hear clearly. The webinar will be recorded. Again, the webinar will be recorded, and we will be sending that out to everyone via email from your registration confirmation tomorrow. In addition, it'll be posted on our Sales Boost website. We will be having Q&A throughout. There is a Q&A feature that you can type in questions. Feel free to do that during the conversation. We will have time at the end to take Q&A, but we also like to address your questions as you have them. You can also chat. Some of you have already told us where you're logging in from, so you're experts there. Just make sure that you select everyone in the meeting so that way everyone can see your question, or you can send your question to the panel only, or you can send a chat to individual panelists as well. So that feature is there for you. All right, and then finally, about Sales Boost. We again are honored to host the webinar today. We are an on-demand training and coaching solution for hospitality. Our focus is on accelerating human capital to ensure that they achieve optimal performance. We will provide more information about Sales Boost at the end of the webinar. And again, thank you for joining. Okay, so now it's time to introduce our expert panel. We have many panelists that bring a wide variety of experience. And so first, we'd like to introduce Ned. Hello, Ned DeLorme. How are you today? You're with Jupiter Holdings. And ladies and gentlemen, Ned has been a Jupiter partner since 2018. He brings nearly 40 years of real estate investment and finance experience to the team. He is going to provide us with a lot of advice, content, and information. So we're thrilled to have you join the panel, Ned.
Thank you.
Hello, Rick. Rick Kirkbride, partner with Paul Hastings and chair of the Hospitality and Leisure Practice Group with Paul Hastings. Rick brings nearly 30 years of experience representing institutional and real estate companies and capital providers in the acquisition, development, finance, and operation of hotels, resorts, and other hospitality properties and businesses across the globe. Welcome, Rick.
I wish it were not that it was more than 30 years, but it is. 33.
I'm in the group.
Really. Next, we'd like to welcome Suzanne R. Mellen. Suzanne is the Senior Managing Director and Practice Leader with HVS. And Suzanne has unparalleled experience having appraised thousands of hotels, gaming assets, and related real estate throughout the world. And she specializes in complex hotel and casino feasibility issues. She's nationally recognized for her industry expertise. Also wanted to call out that she's a speaker in demand for conferences throughout the US, such as Alice and JMBM's Meet the Money. Suzanne, welcome.
Suzanne, tell them that our very first workout conference that the two of us did for hotels was in 1990. And here we are 30 years later.
Yep, history keeps repeating itself somehow. Yeah.
Greg Mount, founder of Victory Hotel Group. Greg, we're so thrilled to have you join. Greg brings more than 30 years of experience in the industry with brands such as Marriott, Starwood, Sage Hospitality, and Richfield Hospitality, where he was president. And then he made significant impact as CEO of Red Lion Hotels. Most recent adventure, of course, is founder of Victory Hotel Group. So welcome, Greg.
Happy to be here.
Mr. Paul Novak, we're honored to have you with us. Paul is one of the premier development and acquisition executives within the hotel industry. He has acquired or developed over $4 billion in hotel assets over the past 40 years. And he's had a variety of leadership roles, namely with Marriott, where he participated in the formation of the Courtyard by Marriott product. So he's got extensive experience in acquisition and development of hotel assets and will no doubt add to a lively conversation today. Thank you, Paul.
Welcome, everyone. It's nice to be here.
And I also wanted to introduce Greta Brooks, the founder and CEO of Sales Boost. Greta, thank you so much for sponsoring this webinar today. We appreciate it. And I know that your extensive background in hospitality in both operations and in sales, you've managed global sales for Hilton, Marriott, and Omni, and you have founded now this wonderful solution for Sales Boost. So thank you.
It is a pleasure. Welcome, everyone.
And of course, we are so happy to welcome back Dr. Donald Wise. Dr. Wise participated in a previous webinar that we hosted as a panelist, and now Dr. Wise is going to be facilitating the panel today. And we have to say that Dr. Wise is co-founder of Turnbull Capital Group, but also founder of CBRE Hotels. We're so thrilled. And not only has he had an accomplished career in hospitality, but he has also, and finance, but he is also a highly decorated former United States Marine Corps combat veteran. So Dr. Wise, thank you so much. And I'm going to turn it over to you.
Fantastic. Good day, everyone. We have people from all over the world, so I don't want to say good morning or good afternoon. As Forrest Gump might have said, and just like that, we're in a down cycle. I'm the co-founder of Turnbull. Have a great team of 7 other professionals that work with me. Very proud of our group. We have closed, we tallied it up yesterday, between our 8 senior members, all with over 30 years in the business. We've closed over $19.5 billion worth of either consulting, property management, operations, and so forth, the hospitality space. So we're, for all the wrong reasons, but for very good reasons, we are very, very senior guys in that space, and delighted to be participating in this conference today. Our sponsor, Greta, founder and CEO of Sales Boost. She's been in the bullpen warming up. Let's get to it. Do you have a quick question for now, Greta?
I do. I get to throw the first pitch or the first ball. I missed opening day. It's such a fun day. All right, to open it up, I wanted to ask the question that has been of debate very recently. In fact, on several webinars, we've had this debate. And so really to the panel, you know, what at this point for an asset owner is the most important thing? Is it revenue that we should be focused on now, or is it on the flow through and the profitability? And really, whether you're in a franchise company, you're in a management company, or you're on site with an independent hotel, it's really important that we understand really what's in the mindset of the people who are own these assets. So I pitch it or throw it to the team here, the panelists, to see what their thoughts are on that.
I'll pipe in. This is Suzanne. Hi, everyone. Welcome. I know, great question. I think if from the ownership perspective, I think flow through and EBITDA and value are critical assets, because at the end of the day, you're going to have to pay back your lender and generate a return on investment for your investors. And it's going to be interesting to see how it plays out. As we all know, we're in this challenging revenue environment, and many, if not most, hotels are not generating any EBITDA right now. So clearly we have to focus on the revenue and get that back going, first occupancy, then ADR to follow, contain costs. But then the value, I think the potential for value is once we bottom out. We saw this in about the beginning of 2010, once investors recognized that the market had bottomed out and the only place we could go was up, investors jumped in, and all of a sudden we saw a tremendous drop in cap rates because the people were starting to buy it based on future recovery. And that's when we started seeing accelerated value recovery that exceeded the growth, the near-term growth in revenue. So it was really based on buyer expectations. So I imagine that will happen this time around too. May take a little longer till we get clarity as to where the market's going to truly bottom out with a prognosis for upside.
Great.
That's great.
Paul, you want to hit it?
Yeah, I think right at the very moment, the the focus has got to be on expense control, and that's probably going to continue for at least the next 6 to 8 weeks, because I don't think anybody's having any success, or at least not much success, in generating revenues and occupancy, just because the demand just isn't there. So our focus has been to minimize the amount of labor costs and our costs associated with keeping the hotels open, but trying to chase whatever little business there is out there. In most cases, there isn't that much, although we do have a couple of hotels that have continued to perform the last 5 or 6 weeks around 25 to 30% occupancy, which for the industry at the moment is extremely good. The only product I've seen out there that's been able to maintain or generate its revenue base has been the Woodspring Suites concept, which is a former Jack DeBoer product called Value Place, and they've finished the month of April at 68.9% occupancy.
Wow.
For a system with 250 hotels. So there is some demand out there, but again, our focus is on maintaining costs until we see travelers starting to return.
Greg?
Yeah, look, I think everything that's been said so far is spot on. I think that, through my career, I think one of the things that I've always learned is that you're never going to, cost engineer your way out of an issue. It really comes down to revenue generation. And I think that, from a different perspective on this, I think as owners and operators and brands, et cetera, we need to start thinking about the short term, the medium term, and the long term. And what I mean by that is you see everyone running out right now to try and figure out, the best surface cleaning products or the best protocol as it relates to cleaning the room in the hotel and preparing for it. And I think there's a much longer term view on that, which really says, okay, after the first, 2 or 3 months, as we start to exit this, what is the consumer really going to be looking for, and what are they going to expect when they come to a hotel? And I'm not so sure cost containment really necessarily directly correlates with that. But I think your revenue growth is, and I think those hotel owners and operators that have figured out, that not only surface cleaning, but air filtration and training for not only their associates, but also the guests that are coming into their assets are going to be extremely important. And then as it relates to value, I think that no one has an accurate crystal ball, but I think that consensus, at least from how we're underwriting right now, we're seeing, we're figuring we're going to get back somewhere to 70-75% of value in the next 12 to 18 months. And then from there, I think it's going to be based a lot on the group meeting business and how quickly that does return.
Excellent. Ned?
Mute. Ned, mute.
Ned?
Unmute. Okay. Yeah, I agree. I think the biggest problem right now is there's just no top line. So it's wonderful to try and contain costs, because you have to do that, and you certainly have to slim down. But until there's a sea change in revenue and demand, it's fairly hopeless.
Rick, you want to opine?
Well, look, first of all, unfortunately, out here in California, we have last week, a new order that came down from Gavin Newsom that essentially said no hotel in the entire state of California could accept leisure business. And there is no backdoor date to how long that's going to last. Wow. Secondly, yesterday, it was announced here in LA County that we're going to stay in shelter until the end of July. So whereas there may be a lot of places around the country where they're beginning to open up and you might see revenue sooner than later, our government officials here in California and Los Angeles in particular are continuing to clamp down, and there just is no end in sight. So that's going to have a real long-term impact on value. I think that most of our clients that are looking. You know, I don't believe anything is traded yet. There are sellers out there that need to sell assets. They've been listed, they're being marketed. Obviously, so is the debt. But the reality is, if you were to trade today, it sounds like you would be accepting maybe a 35 or 40% discount off of pre-COVID values, which were only 2 months ago. So it's not, unfortunately, it's not a pretty picture, especially on the two coasts, New York and California.
Thanks, Rick. From a workout perspective, the first thing we always look at is cash preservation, because obviously operating shortfalls are going to continue for quite some time, especially in lieu of what all the panelists just agreed on. So that's the only thing I would contribute, is that saving cash and having that cash available for ongoing expenses, et cetera, from our perspective is kind of ground one or point one from the standpoint of representing the borrower. Suzanne, I got a question for you.
Yeah.
I hate to stick on California, but this happens to be a California statistic. California is in literally a financial tsunami. We have an 18% unemployment rate as of today, and nearly a 9% decline in California personal income. How is this data state by state going to affect HVS's computer algorithms as far as your next generation and appraisal analysis going forward?
Yeah, pretty bleak statistics, huh? And thanks for that update, Rick. I didn't realize California had shut down hotels for leisure business. That's pretty shocking. Well, for most, I want to differentiate between feasibility studies and appraisals, because when we're conducting feasibility studies, we're looking into the future, and amazingly, we still are conducting some, but all the people that we're working with are looking beyond this. Nobody is anticipating having a hotel open up in the midst of this. Everybody's like, you know what, we have to assume normalization. Let's look out, 2-3 years and see how, assuming that the market normalizes. The challenge in that, which we tell everybody, is where's your average rate going to fall out? We can all hope that demand will recover, but at the end of the day, it's that average rate and how much is it going to fall and how much is it going to have recovered by then, and that's the unknown. So it's very hazy, but people still want to build and develop hotels, and it takes a long time to do so, especially out here in California. So that's ongoing. As far as the appraisal goes, we don't use algorithms. There are firms that use algorithms in developing their demand forecasts. We prefer looking at, trends. We have a lot of different data sources that we analyze, and we have a lot of boots on the ground. We have 40 different locations, people in 40 different locations across the country that are constantly staying in touch with what's going on. It's going to be very micro market, big picture looking and figuring out the state regulations, what kind of product you're talking about. Are you getting your demand from out of state, in state? It's going to be very tough. I mean, there's a lot of cloudiness right now in terms of forecasting, but at the end of the day, doing appraisals, we actually are charged with the task of reflecting the market participants' views. So a lot of it's going to be based on how buyers are looking at these assets and when are they anticipating things to recover and how they're expecting assets to perform. So it's just a lot of granular research, talking to people, analyzing data, and doing the best you can. And there's no science to it. And one rule of thumb we always say is whatever you project today, tomorrow your projection is not going to hold true, because things are always changing. So.
Well, the good news is you have 3 buyers on this panel today, so this should be interesting.
Yeah, yes, great. I want to hear what you have to say. Yeah.
We're going to have to readjust our NOIs, obviously. As we get past May or June, I wrote this a week ago, we may have to think June or July or August, September in the case of California. We have to find price discovery, and the more closely we get to that, then we'll start discovering our values. We seem to have a consensus of 35%. Off market right now. It's kind of the comment I've heard a couple of times on this call. How is Whitman Peterson going to look at and evaluate hotels?
Well, I don't think that we, as well as almost anybody else out there, is in a position to really buy today, because I think it's impossible to really establish what the value is, whether it's decreased 35% or 60% or 75%. I'm just not sure that any of us know really where it is. I mean, we've valued our portfolio of hotels in the last couple of weeks. And, you know, we're not going to be a seller. We're going to ride this out. But we believe it's probably going to take till 2025 for us to get back to at least close to the values that we felt we had at the end of 19. Now we're in a position to hold and wait for the business to come back. So I guess the bottom line is that if you want to know where the V in LTV went, I think it got a little confused with the seasons, and it went into hibernation in March, and it's going to spend 6 months in hibernation until at least next October.
That's very interesting you said that, because I can't tell you how many times in the last couple of weeks with all of us at home, people have been calling this similar to the Groundhog Day, the movie. Greg, there's a real danger in the hotel sector that more costs are going to be an ongoing expense, and reopening is going to be clearly challenging and problematic, with the burden of responsibility clearly on the ownership as far as generating enough revenue to make economic sense. This is just a very challenging issue. We've been underwriting, Michael Brennigan, my partner in crime, has been underwriting these deals and trying to figure out operating costs and incorporate that delta for additional expenses for cleaning and other. How are you looking at that conundrum as far as your buying assumptions going forward with the Victory Hotel Group?
Yeah, you know, I think that we take a much broader kind of approach to what we're looking at. You know, we've been fortunate to put together a fund that allows us to look at assets, you know, acquisitions, you know, preferred equity, you know, debt acquisition, and each of those has a little bit different nuance to it. And, you know, we're looking at anything from 10 to 400 million, and we're coming in all equity. So we're kind of going into this with our eyes wide open and not really relying upon debt to be able to make these acquisitions. And I think part of the important nuance too is that, you know, you really can't be predatory on this. I think you've got to, you know, to look at this and say, okay, we need to get a fair return on the equity risk that we're taking, but at the same time, you know, I don't know that we really saw this in the last downturn, that, you know, you're going to be buying assets at 10 cents on the dollar. So I think when we look at this, we say, look, there's definitely going to be some additional expenses, you know, potentially some capital expenses that are going to come along. But really for us, it's really kind of establishing the benchmark prior to the pandemic and just assessing, you know, where we think that will start to alleviate itself. And as I mentioned earlier, you know, we think that's the next 12 to 18 months that we get back to about 70 or 75% of where we were. At the same time, you know, I think that you know, no one has a crystal ball that's going to be able to really, you know, give anybody any distinct direction on this. So there's inherent risks with doing this. We are starting to see, you know, properties come, you know, out for, you know, acquisition opportunities, portfolios, debt, etc. We are having conversations on the preferred equity side. But most of the discussions are really around when we think that there'll be a return. We tend to focus on, you know, assets that are well located. You know, we pivoted from our prior kind of assessment of looking at assets where we were rebranding and restabilizing because of obsolescence, and really pivoted to more, you know, stronger CBD locations, locations that are, you know, under the Marriott, Hilton, you know, potentially ISHC and Hyatt brands, you know, just given their propensity to recover more quickly. So, in a long-winded answer, I think that there will be some cost adjustment, but I don't think that's our primary part of our analysis when we're looking at these assets or these opportunities.
Well, I commend your approach as far as being more of a white knight. We've actually been creating business models along the same line to be a more of an angel investor than a quote unquote, you know, predator or bottom feeder. I like that approach very much. Ned, you're up.
Yes,
What
sir.
what sort of higher returns is Jupiter going to expect with today's risk and obviously very much less liquid hotel markets? far as liquidity and capital
Well,
markets?
well, it's too early to tell, and there's really no way to calculate, because your guess is as good as mine. I mean, I'm much more optimistic about a relatively quick recovery. I mean, I think a year from now we'll probably be back, not to normal and maybe not to 2019 numbers, but I suspect the trend will have established, and we'll be back on an upward sloping demand. I don't think the economy can stay shut down. I think it's just, human nature. People are going to want to travel. They want to get together. They want to do business. They want to see things. They want to meet with people. I think there's no way that's going to stop. I mean, we've been dealing with viruses and pandemics for hundreds of thousands of years. Thank God we have the technology to better handle it now. But I don't know when we're going to be back, but we are going to be back. So from our point of view, we're gathering data. We're looking at opportunities. We think that the tsunami of CMBS maturities is going to be an opportunity, as a lot of people just throw in the towel on non-recourse debt. Special services are going to be, well, they already are overwhelmed. And there'll be a period, 3 months, 6 months of sort of suspended animation. And that it's sometime this winter, I think there'll be some, interesting opportunities, at least on the buy side, as people just throw in the towel. So.
All excellent points. I'm a little stale. I haven't seen a number in about a week and a half, but the last numbers I saw was we had $100.7 billion worth of CMBS and forbearance, which I believe was about 17% of the CMBS universe. So, and again, that's a stale number. I haven't seen an update, and that's about a week and a half, maybe 2 weeks old.
Right.
Just to Ned's point, it was just a Harris poll that was released this morning. This is fresh information. I'm just inserting it here. That said that 42% of the people surveyed said it'd be 6 months before they get on an airplane. The outlook was even bleaker for the hospitality industry, as 52% want to see a flat infection curve for 6 months before they think about staying in a hotel. So again, we just have so many challenges. Rick, I think you're up. We have opening dates for hotels, maybe not in California, but in other places on the horizon. And many hotel owners, of course, are concerned about liability issues. Some of them even debating the necessity of drafting a waiver or a release of liability for upcoming guest days. What's the right answer here, Rick?
Well, first of all, I'm just going to point out that we have written, if you can see the heft of it, it's a 100-page roadmap for distressed hospitality assets. And it goes through every single aspect of closure and reopening and employees and everything else you can imagine. So we'll send this out to all attendees of the conference this morning. But yeah, hotel owners are right to be concerned. They should anticipate the need that they'll have to meet various standards of care for their guests with regard to COVID-19, as the hotels are going to face exposure to claims asserted by guests. You may know that there is an effort underway in Congress. The Republicans are pushing for some sort of an immunity for employers in hiring back their employees, as well as potentially from guests, but mostly from employees. But the standards definitely vary from state to state. In this book, we have at the very end a 50-state survey with every state and every major city as to what the current COVID restrictions are for reopening. But the hotel owners do a standard of duty to their guests to take reasonable steps to reduce the potential harm for pathogens. What will be different is the steps necessary to meet those standards, as COVID-19 may increase owners' obligations. In fact, from specific locale to locale, so should the hotel safety practices. So for example, if a hotel learns that has a guest with COVID-19, it is likely it will need to take additional responsive steps with respect to existing and future guests. And I have a list of those we can talk about. If a hotel learns that there's been a huge surge in infections in its locale, it's possible that additional cleaning regimes may be needed. But the most risky part of us all, though, is tort liability. We did a return to well, not really return to work, but return to hotel and opening of hotels webinar last Friday. And we had half a dozen different guests in addition to lawyers from our firm. And those guests really focused on, among other things, the potential tort liability that's going to come from this. The duties may be measured against local, state, and federal guidance, but the standards are not necessarily defenses compliance. There's a number of ways that hotel owners can increase their confidence with return to travel without scaring off. One of them is, believe it or not, waivers. So in California, again, since we have this no leisure rule, we're advising our hotel owners to have the guests who do sign a waiver and a release, not only as to any COVID-19 issues, but also indicating that they're traveling for business. I was watching television last night, which I rarely do anymore, and it's just shocking to me that the city of Los Angeles has nothing better to do than to actually have people go into restaurants where restaurateurs are trying to do, serve guests at the curb or whatever it might be, takeout. They're planting people in the restaurant who then say, oh, do you mind if we order and just sit here and have dinner or have lunch? And now those people that they have been sending around to restaurants throughout LA, they were in fact acting on behalf of the city attorney. And now the city attorney is bringing charges against these restaurateurs. So it just boggles the mind how our government can do what it's doing and create so many issues for our hotel and restaurant owners. On this particular topic I just closed, again, another great California development is the city of LA last week passed an ordinance, or whatever you want to call it, that requires hotels and restaurants in hotels to hire back. When they do hire, you have to hire from the pool of employees that you terminated, and you have to hire those employees with the most seniority first. So not only do you have restaurants and hotels that are going to do everything they can to try to ramp up in business, somehow pay their rent while they're waiting for customers and waiting for this thing to end officially so they can start to drive revenue. And yet they have the government in so many ways imposing restrictions are going to make it that much more difficult. The latest numbers I've heard is that the expectation is at least 25% of restaurants will never open back up.
Well, all I can say is welcome to California. And now you wonder why so many firms are going to Texas and Nevada. Suzanne, coming out of this, and as Paul rightfully pointed out yesterday, not all hotels will be opening at the same time. Many of the bigger boxes that are more focused on convention and conference business will probably wait from a lag time standpoint. But other than those, there'll be a tremendous amount of hotels basically opening at the same time. As I say facetiously, the beauty pageant is on. How are you going to figure out, from the standpoint of your appraisals, the cumulative effect of so many hotels opening at the same time?
Yeah, well, good question. Rick, I just wanted to thank you for sharing that guide with everyone. It's really a phenomenal piece of work, and will be, I think, great help to all of us. As far as reopenings, I don't think it's going to be a challenge like everything else, like figuring out what demand's going to come back when and what hotels are going to open up. It's going to be very cloudy. I don't know if anybody says they have the magic formula to figuring it out. I doubt that that's true. What I've been hearing is about 15% of hotels are closed. So it's not as big, it's not as pervasive as an issue as we might think. And it's interesting, I was Googling last night just to check in some of the major cities, and it's amazing all the hotels that are opening and popping up for room revenue tomorrow, even some of the larger hotel assets. So there still is, a lot of supply that's out there that's going on. And I think it's going to be very granular research. It's tough to stay on top of these hotels. We've been trying to stay on top of, in the major metro markets, what hotels have closed, which ones are planning on closing, which ones are planning on reopening, and it's just a constant process. But the key is to talking to operators and trying to understand what their thinking is behind when they're opening up, what their demand sources are going to be, and really drilling down as to what's going on, and then doing the best that you can. I mean, because, you know, as they reopen, I doubt that they're all going to open at once. Reopening is very much a property by property, owner by owner decision. And it takes a lot of analysis and it costs a lot to reopen. I think it's going to be phased in, and hopefully they'll reopen in tandem with the demand, you know, the demand that's evolving. And we do know that supply can generate some demand, but I guess I'd have to take that back for right now, because right now there's no demand to be had. But once we start, you know, maybe once we move past the summer, things will start to look better. I just have to say, because we were thinking the summer was going to be the real recovery point. Maybe because I'm located in California, it's sounding rather bleak right now after what Rick said. So, but it's going to be, you know, micro market research gone, really.
Well, and I got to say, have known your firm for so many years and having spent 2 summers at Cornell with Steve Rushmore, the HVS team, both domestic and internationally, his reputation is of course stellar, but more importantly, they're boots on the ground people. They just don't sit behind their computers. They actually go out and talk to hotel operators and management companies and so forth and so on. And that is really, I think, the key to their success as far as data versus deep data. It's not deep data, it's actually talking to all these hoteliers and so forth and so on. Paul, back to you. I think this is a little redundant. I apologize for that, but we're still trying to drill down on these values. The Lodging Industry Investment Council members agreed about a week and a half ago that hotel values have taken a hit from the crisis, but they were split on how severe the drop has actually been. A total of 40% believe that hotels have gone down in value over 30%. 25% of respondents expect the drops between 10 and 20%, and 25% of the respondents expect the drops of between 20 to 35%. Again, I hate to nail you on this, but what's Whitman's Peterson's view on those numbers?
Well, it's easy to nail me on this one because my answer is all of the above. So I don't think any of us on this panel, and if there is somebody that can guess which one of those 3 is the more likely, should probably get the award for the day. I don't think we really have any idea right now what the net impact is going to be on values, and even how to determine what the value is. I think that trying to value an asset based on a cap rate is, from my perspective, is out the window, because there's fundamentally not any sufficient NOI to support an analysis based on cap rate. Maybe the best you could do is to anticipate when you get back, when a hotel might get back to 19 levels, and then apply a pretty conservative cap rate to that. But I honestly believe that for the next couple of years, most assets are probably going to trade on a per pound basis, that being a per key. And it's going to be based upon how long you have, what your staying power is for that asset to get up to a value that is going to represent an opportunity to get a reasonable return. And I think that based on the risk factors, the returns that people are going to be looking for are going to be higher than they were in 19. I think, you know, while they were starting to come down for a lot of investors who might have been in the low 20s, might have come down into the mid to high teens. I think with the risk associated right now and for the foreseeable future, to invest in a hotel, you're going to have to figure out how you're going to end up with an excess of a 20% return.
Yeah, that's certainly not surprising. I think Jonathan Gray and Barry Sternlick are both talking mid-20s. I know that Driftwood, I believe, is talking mid-20s. It's going to be case by case. One question, Paul. I believe in your concept of per pound and per key. You want to take a chance on saying plus or minus 5, 10, 20% of replacement value on that equation?
Ooh.
Plus or minus either way.
Probably, well, the replacement value is almost irrelevant today too, because I can't see for the next 2 or 3 years how you're going to be able to support any new construction. But if you go back to 19, I would venture to guess to buy in the next 2 years and to take the risk as to how long the market is going to take. And you're speculating now as to what's going to happen, say, over the next 18 to 24 months. I'd be hesitant to buy an asset for much more than maybe 50% of its value per key in 2019. And there are going to be a lot of owners who simply will not sell at that rate. But I think, and they're going to have the financial wherewithal to weather this storm for at least another 12 to 24 months. And then we might start to see some transactions from people that didn't need to sell today that might consider selling 2 years from now. So I think most of the stuff that probably is going to come to market will be people that just don't have the financial wherewithal to carry these assets for another 12 to 24 months, or who have already thrown in the towel, given the keys back, or just waiting to be foreclosed.
Well, that segues very nicely with our conversation earlier, my comments earlier about cash flow and maintaining cash from the standpoint of a future workout and so forth. Greg, I had a similar question. You want to go ahead and kind of hitchhike on Paul's comments there?
Yeah, look, a couple of things. One is I think that you're starting to see, investors start to also kind of look at the multiple, right? And I think you're going to have to be, north of a 2 multiple on anything that you're looking at now, and that may start to become more important actually than kind of some of the typical IRRs that we look at and some of the return thresholds. For us, and you talk a little bit about markets here, and I'm going to talk a little bit out of both sides of my mouth. I think that one of the things that I've learned through a couple of these cycles in my lifetime in this industry is that in the end, business has to get back to doing business. There's just no two ways about it. So at some point, business will get back to doing business. And I think for us, as we look at these markets, and really it becomes a little bit about the market, but it also becomes more about the opportunity. And I think that I think quite honestly, you may see some secondary and tertiary market opportunities that may stabilize or come back sooner. I think you're seeing some of the limited service and economy hotels actually doing, not great, but better than most, just given, the type of users and people that are using those hotels. So for us, we're looking at kind of a real bandwidth and less market centric. Quite honestly, a couple of our folks, and I tend to follow them, are scared to death about Manhattan. We don't know how Manhattan's going to come out of this. And I think that that's a market that quite honestly could be a real concern going forward. And I think you'll see some people kind of get sucked into that based on what Manhattan used to be. Now, out of the other side of my mouth, you look at Manhattan over the course of the various cycles, and it's basically maintained an 80% occupancy for the most part. So I think that there's just a number of things that are going to come into play here. And for us, I think opportunity first, market second, and then we come in with the segment. No one's going to go out there and vacuum up a bunch of assets right now. It's just not going to happen. I think that Paul is absolutely right. I think it's going to take a little bit of time. And speaking with a number of owners, they're going through that decision process right now. Given the value of my asset, do I continue to pump money into this thing, or do I turn the keys back? And I don't think people are at that decision point at this very juncture. I think you're going to have to give it a little bit of time. But at the same time, there are some owners out there that have some very significant cash flow issues. And so those opportunities are the ones that at least we're focused on, and to try and be more of a white knight and see how we can team up with them and create a good win-win outcome.
Yeah, I would agree with Greg, and to piggyback on his comment about multiples. When I mentioned that we're probably looking at 2025 to get the values out of our assets, it really is more focused on the multiple and the cash flows that we can get leading up to 2025 than necessarily getting back to the IRRs that we thought we might get when we made the initial investments. But the multiple becomes a far more critical aspect for the next few years.
Well, just dovetailing on both of your comments, and specifically Greg's comment, the reason I think that the white knight approach is very compelling is that when you look at these hotels, the risk in the hotel, the majority of risk has already passed. It's already been built. There's no concern about your steel costs going up mid-construction. It's already stabilized once. It's already known the community. It's already got a band of Marriott or other frequent flyer customers that have been there before. So the risk in the proposition really comes down to, is it going to stabilize in 18.3 months, 24.7 months, 38.2 months? And is it going to get back to where it was before? I.e., is it going to get back to 75% occupancy where it's functioned for so many years? Or has there been a real bona fide paradigm shift in hospitality, and it will never get there again? It only gets to 67 or 68, and you have to underwrite it accordingly. Going back to a previous comment of Rick's about restaurants, and just dovetailing on what Greg just said, the talk around town is that somewhere between 10 and 30% of the hotels in Manhattan will not even reopen. They'll be converted to some sort of multifamily or other use. So these are all regrettably, they're with us and we can't hide from them, but these are all very real world issues. Ned, you want to hitchhike on that for a sec?
Yeah, I totally agree. I think there's the we always, for the last 25 years, we've been joking about how we're not overbuilt, we're under demolished. So I suspect that this time there will be a lot of hotels that just don't reopen, particularly the older, functionally obsolete big box. Lots of meeting rooms, lots of outlets, lots of F&B. That model just doesn't work anymore, and except in certain markets. And even in those certain markets where it used to work, like New York, I think your point is a good one. The demand destruction created by this thing, no matter even if it bounces back quickly, there's been so much damage to the capital structure of these individual hotels. A lot of them will just get liquidated. In our sense is the sellers are going to be the lenders and the CMB, the special servicers, and undercapitalized sellers who just finally throw in the towel, or well-capitalized sellers who throw in the towel and, have non-recourse debt and just make the calculation that, hey, we got our money out, have a nice day. It's gone. So on the one hand, you'll see, I do believe that demand comes back eventually, maybe not to the record levels we had in 2019, but it will come back. And the undersupply, the decrease in supply, particularly of these functionally obsolete boxes, will probably help the rest of the hotel universe to perform better. So.
Great. Rick, we're looking at a down cycle. We've been through them before. Two-part question. Do you see this one pretty much resolving itself the way the 2008-2010 cycle came down? Or second is, how are you, as Paul Hastings, working with borrowers to help themselves as well as lenders who regrettably have to make that hard decision of foreclosing?
Well, I think it's stay alive till 25. In the Great Recession, we went from 72 to 60% occupancy, 60% occupancy, 58, whatever it was. It wasn't 72 to 0. The hotels continued to operate. they didn't close. And they may not have covered debt service, but they were covering operating expenses. Obviously now we have hotels that litter the landscape that don't generate any revenue, let alone having $300,000, $400,000, $500,000 a month of negative cash flow. So I think it is stay alive till 25. Even if we get back to NOIs in 23 that were 19 or higher, I think there's going to be a permanent impairment on hotel capital. And what I mean by that is, of course, is that cap rates are going to go up, not down. I think that institutional investors are going to see hotels as being far, far, far riskier investments than obviously office or industrial or many other asset classes. So I think we have some real issues there. I guess somewhat of the good news is that in a lot of ways, right, we still have non-recourse carve-out guarantees that have been largely executed by warm bodies. So we won't see a lot of bankruptcies like we did, although there's going to be enterprise bankruptcies. There's clearly some REITs and some other companies that are on the precipice or teetering. When we are helping clients right now look at acquiring assets, you know, you kind of have a whole chapter on acquiring distressed assets. And in the Great Recession, you could look around and make sure that they were all operating hotels. So you did have financial statements that you could rely on. You did know where the issues were hidden more or less just by some fairly decent due diligence. Now we're looking at hotels and finding out that transient occupancy taxes now haven't been paid for months, if not longer. Sales taxes, needless to say, on the employee side and payroll side. And you know, in many states, you have successor liability as a buyer. So it's not like you can just close your eyes to any unpaid employees or issues like that have arisen. So you can go down the list of, if you will, horribles that could have happened in these hotels, particularly closed hotels, and it's really a long list. So I think that number one, we're looking at obviously a very, very steep decline, and somebody described it as a swoosh, a Nike swoosh, maybe coming down. But I do believe it's stay alive till 25, and there's going to be a lot more hotels that are come on the market. Blackstone said it'll be 10, 12, 14 months. I think for the really significant assets that people don't want to let go, and they're going to hold on and do everything they can. But boy, are there a lot of limited service or tertiary market kind of assets that even great institutional owners, clients, et cetera, are saying what was said earlier. Here's the keys. We're not putting any more money into this. It's going to take, God knows when the hotel is going to open, let alone get back to any semblance of occupancy and RevPAR. I remember the W in Union Square in the Great Recession. And the clients had, I think, a $260 million loan on it at the time. And it was valued, and it was still operating. It had revenue. And it was valued at the time of $50 million. I'll never forget the appraisal that came in on that hotel at $50 million. And we're going to see that all over the country, and particularly major markets with these really big box hotels that really don't have any not just leisure, but the meeting business, right? Is what drives so much of our business. The meeting business is going to take a long time to come back. I hope it does, but it's going to take a long time.
You absolutely nailed it, Rick. I can remember back, I believe it was 1990, when the Bonaventure Hotel in downtown Los Angeles was being foreclosed on by, I believe it was Equitable Real Estate. And there was another firm, not HVS, by the way, Suzanne, that had done an appraisal the year before and had based that appraisal basically on the sale of the Hotel Bel Air, which of course was a ridiculous comp at the time of $1.2 million a room. And they had appraised the Bonaventure at about $288 million. And as you may recall, when that sold to the next owner, a Taiwanese gentleman, it sold for $56 million. So this is not a story, regrettably, we have not heard before.
Can
Paul,
I just, I just wanted to ask a question of Rick or the group, because I've heard from some owners that, you know, when people talk about giving the keys back to the bank, that the lenders are not going to want, a lot of lenders aren't going to want the keys because they're not going to want to have the cash flow drain. And these hotels are going to be like hot potatoes, like who gets stuck with this? And so I'm just putting that out to the group. I mean, is there going to be another RTC for hotels, or what's going to happen to these assets that people don't even want to own because there's
Let me just say, from a legal point of view, I think a lot of it's going to be driven by personal liability. So for example, on franchised hotels, where one of the brands got Warm Bodies or an upper tier fund to execute a non-disturbance agreement or a comfort letter, I think that that's going to come back to haunt a lot of people who thought, well, here's the keys, I'm walking away, but there's liquidated damages, which are normally 5 times trailing royalties and other fees and charges under those agreements. And those Warm Bodies are personally liable, or those upper tier funds, whatever they might be, are personally liable for that. So I think in every instance where we have people coming to us and talking about giving back the keys, and trust me, there's a lot of that, we really do have to look at a variety of things. There might be partners in your partnership that don't want to give back the keys. There may be tax consequences. There may be, like I said, personal liability. There may be successor liability. So it's with every single deal, we try to kind of look at our little checklist and survey the landscape and figure out where the mines are. And then to the extent that there really aren't any of those lingering problems, and there may well not be, then, you know, I've had, the other complexity here, of course, is that you have also management companies, not just branded, but independent management companies that have been operating these hotels and themselves incurring a tremendous amount of potential liability on their books. So they're at the table too, trying to say, hey guys, if you, lender and borrower, can't figure this out, and we've had this a few times, we're leaving the keys on the front counter, on the lobby desk, and we're out. And we'll take a little walk around the hotel every few days or something along those lines, just to check on it from a security point of view. Well, that's truly untenable. And so somebody is going to have to come to the rescue and bring in kind of a caretaking exercise, management team or whatever. And then I suppose whoever that is the one who either has risk from a personal point of view or is trying to really preserve value. And that's the only thing they can do.
To address what you commented, Suzanne, I think that's where we're going to start to see assets come to market.
Yeah.
Is that these lenders are not going to end up with a choice. I mean, they're either going to get the keys back or the asset's going to be locked up and deteriorate. So my bet is that the lenders are going to be faced at some point with significant write-downs on the assets and just peddle them as best they can to get whatever they can get out of them, because they're not going to be in a position to carry the cash shortfalls for the operations themselves. So I think that's where we're going to see it. I think the other comment too, in conjunction with all this discussion, is that there's a dramatic difference between certain assets, both, I think Greg mentioned it, not only the positioning of the asset, the brand, but the submarkets that they're in. Suburban roadside markets, maybe not tertiary markets, but suburban major markets may come back much faster, which tend to be more drive-in markets. I think Barry Sternlick a week or so ago on the Walker Dunlap interview indicated that you know, he believes that, and Starwood Capital believes, the assets are going to come back that are in the suburban select service faster than other assets. So some of the comments about things not coming back till 2021, 2025 is really dependent upon the particular submarket. We're hoping, and at this point, all anybody can do is hope, that many of our assets that are well positioned in suburban locations or 150 rooms with really solid brands on them may come back to 19 levels NOI wise by 21 or 22. My comment of 25 was really just to get the maximum value out of the asset that we invested in originally.
Well, the other issue, of course, is the fact that every category, as we've talked about, is going to recover differently. Clearly, the drive-to markets, if we follow what happened after the terrible events of 9/11, came back relatively quickly. But as we saw earlier with the Harris poll, as far as airlines and aircraft, you know, that makes Hawaii, Las Vegas, Mexico, the Caribbean, all of those regions are going to have a very, very difficult time getting back, just because I don't think the public is going to be terribly anxious about jumping on airlines. Greta and Andrea, I think we're a little bit over 10. Did you want to share some questions, Greta, for the group that have come in?
Sure.
Yes, I'd love to. So we've gotten a few questions. Bill Edmondson, so he had to jump off, but he left us with some nice treasures of questions. And he asks, is the future more just limited service hotels? And what happens to those big boxes? I think we already addressed what happens to those. But what is the future of hotel building and you know, asset ownership and management?
Well, I think we've already been seeing that trend for many years now. I mean, if you look around the country, most of the new products that have been built have been limited service or select service because of their operating model and lower labor costs, et cetera, lower break-even points. And it's been very tough to build full service hotels. I mean, you can almost count them. I mean, they're just so limited, even in New York City, where you've had tremendous development. A lot of them have been limited service and select service hotels. So I think that trend is just going to continue. And you know, it's going to become more and more razor focused on products that have low operating costs, low labor costs. And that's the only way we're going to continue to have new development for a long time, I think.
Thank you.
I think it's safe to say that from a lender's perspective, construction lending specifically, the pencils are probably down for at least 2 years.
Oh, yeah.
Are we seeing anything specific related to resorts? So we know that Florida and Texas just recently saw a 10-point jump in occupancy on weekends, not so much in weekday, which one would expect. But what is happening, and is there any noise related to resorts? So resorts have, you know, obviously golf and a lot of amenities and a lot of cost, and they're spread out. So what is the thought on resorts?
Yeah, I think that, you know, I think that there is some, and correctly so, some thoughts out there that you're going to see, you know, at least in North America, you're going to see these drive-to resorts, you know, do better than maybe anticipated, just given the fact that you know, Americans are going to want to get out of their homes and do something. I don't know that they're necessarily going to jump on a plane, as the statistics, you know, that Dr. Weiss spoke of before. But I think you're going to see these resorts, you know, speaking with an asset manager on the Margaritaville asset, you know, that they have. And I think that, you know, they're anticipating this, and I think you'll see some of it start to come to fruition, in the sense that people are going to want to get out. They're going to want to get their kids out. They're going to want to, you know, do something this summer. Maybe that's late summer, but it'll have to be a drive-to.
Well,
Yeah,
I think Greg is absolutely correct. I mean, that pent-up demand is something we have to anticipate, and it's there. An unnamed friend of ours who has a smaller resort here on the coast in California, the last couple of Saturday nights, despite the pandemic and other, has been running 81 and 85% respectively. And that's just people that want to get out of the house with the kids, et cetera, et cetera. They have done it without the food service outlets opening other than room service. Spas closed, pools closed. But 81 to 85% in this market, even on Saturday night, that's very telling, and segues very nicely with what Greg just said.
Mm-hmm. Last question here is actually on the food and beverage aspect and side of things. You know, we talked about the big boxes not being able to accommodate a lot of ancillary services. What are you hearing and seeing related to needs for outside food and beverage operators? Versus at bundling that with an in-house? Are we looking at that as a separate entity that we lease to someone else? Or, and I think Rick, this may be geared to you, you know, what is the potential challenge with doing that? And does that help the situation at all?
Not quite sure your question, but are you saying, are we going to move more toward third-party leasing of restaurants?
Mm-hmm. Yes.
Well, I think the entire industry is going to be turned inside out by this. Marriott is a great company. Hilton, Hyatt, the rest of them. I don't think that any of them will look like they do pre-COVID 5 years from now. I think they're going to completely change their business models, and that partially that is going to be far more franchise than management. They've taken on so much liability through this downturn of the hotels being abandoned and the like, that I just think that entire business model is going to change. As a result, you're going to have management companies that are, you know, not demand like they used to, that they manage every restaurant in the hotel. If it's a franchise, they're not managing anything, in which case probably all the restaurants are going to be third party operated, either by lease or license agreement. So I definitely think there's a trend in that direction. You know, that would help solve, obviously, some of our union issues as well. We have so many hotels that are in very high union cities, Unite here and others, that have made it impossible to make any money with restaurants. And one of the ways of trying to deal with that was to lease the restaurant to a third party. And it comes with that all kinds of issues that apply toward the layout and the planning, and do they have street access? Do you have to provide room serve? All these different things that we're going to have to do, and we have done in dealing with the unions. But I have no doubt that the restaurants will be far more third-party operated, probably under leases. But again, the whole industry is going to change so much. We all have to be ready and be flexible, and for people like myself, do everything we can to help the clients make it through, you know, these times.
Well, Rick, that's excellent crystal balling. We're coming up here on turning into pumpkins. So I have a couple last questions. I'm going to go around the panel real quick. The two questions are as follows. Will the recovery for hotels be a V, a U, a L, a W, or a Nike swoosh? Secondly, Barry Sternlicht says 18 months. The head economist at CBRE says 36 months. When are we going to get back to 2019 NOIs? Start with Suzanne.
I think the Nike swoosh, and we may have a little bit more flat and rounded U to that swoosh before we start to recover. But I think that's my call on the recovery. And you said, as far as the recovery, did you talk, that's NOI? Or are you talking?
Yes, please. Yes, just keep it simple. Actual NOI. Yep. Getting back to actual 2019 NOI.
Yeah, and of course, this is always dangerous because it's like an aggregate for the whole industry. And as we've all been discussing, some are going to get back pretty quick and some are going to take much longer. But I would hazard to think it might be longer than 36 months. I'm sorry to say, but that's my gut on it.
We just want to be honest.
Yeah.
Paul?
Well, I believe it'll be the swoosh, with the one caveat that if we end up back in an infectious time in the late fall and winter, then it's more likely going to be a W. But I don't think any of us can speculate on that right now. So I'd go with the swoosh with the caveat that watch out for that W. As far as the recovery of NOI, probably as an industry, I would agree with Suzanne, 23. But I think that in as I mentioned earlier, certain submarkets, certain products, certain brands have the potential of getting back to 19 NOI levels as early as 21 and maybe 22. Most of our projections on our assets are anticipating 22, but they're mostly smaller, well-positioned, select service, higher end brands within the Marriott, Hilton, and Hyatt system.
Excellent. Greg?
Yeah, you know, I will follow along. I think it will be the swoosh. I think it'll be a very elongated swoosh, meaning I think that we will get to some level and we'll probably sit there for quite some time. And I think a big determinant to that will be the group meeting business will really drive a large portion of that. You know, as it relates to getting back to the 19 levels, I'm not so sure we do in the next 5 years. I think that's a tough thing to say. I think it'll be interesting to see, and I think it'll be really important that these brands start to leverage their balance sheets as well to help their franchisees reopen and to get back on track. And I think, you know, dependent upon how much of that you may see may, you know, shorten that a little bit. And you know, I'm not so sure they have a choice. I think they're going to have to do that. I think they're going to have to leverage their balance sheets to help their franchisees. And I think that will have some impact.
That's an excellent point. Thank you. Ned?
Yeah, I would tend to agree with the swoosh. I just don't know what the slope of that swoosh is going to be. I think we do recover. I think we do recover probably faster than some of the pessimists think. Each individual hotel has its own story and its own location and its own management, and good management, bad management. It's an operating business. But I do think from a capital point of view, your basis is going to be extremely important because the volatility of these things is just unknown, and the more volatile, the less risk you've got to take. So you've got to pay less for these assets. So I think the opportunity from a buyer's point of view is going to be from the receivers and the special servicers and the meltdown scenarios, and you're going to be able to pick and choose. I think. Given the tsunami of, I think I saw a statistic where there's $19 billion of CMBS hotel debt coming due in calendar 2020.
Right.
That's an amazing amount of loans. A lot of it is, some of it is larger portfolios, but if Blackstone decides to throw in the towel on some of these deals, boy, Katie bar the door. Could be interesting.
Well, look at what's going on with Colony Capital.
Exactly.
Yeah.
Exactly.
Rick?
One caveat to all of this, and I don't think we're giving enough credit to the American public and people's desires to travel. If there is a vaccine by the early part or mid part of 2021, while I believe that there will certainly be some changes in how hotels operate from a housekeeping perspective, from a food and beverage perspective, once there's a vaccine, a lot of this could be forgotten, and a lot of people very likely could go back rapidly to their normal pace of business and leisure. So I don't think that we should necessarily think that there's not going to be a solution to this whole problem that's going to give people comfort in coming back quickly.
No, those are all excellent comments, Paul. Rick, you want to throw your comment in on the the terminate term?
Just to follow up on Paul's thoughts there, as well as everyone else. Look, there are three constituents out there that I think every one of us have to work very hard to deal with. And I do think that they are the keys to NOI in a variety of different ways. And those are, number one, the brands. I think that the brands have to look very hard at their brand standards and the costs that these hotel owners were incurring and that they're going to have to be flexible in bringing these hotels back online, both in terms of PIPs and FF&E requirements, as well as just their brand standards that drive operating expenses so high. So I think first, the brands. Second, the unions. The unions are going to have to help owners. You know, everyone thinks of owners as all Blackstone, but they're not. We have hotel owners all over the country that they might own multiple hotels, but when you have zero revenue, and depending upon your own structure and your ability to raise capital or not, it's a real challenge. And I think the brands have got to step back and say, we're going to be your partner in this. We're going to make it as easy as we can for you to get open. And then the third is the government. The government is making it extraordinarily difficult on hotel owners. The entire PPP program was an absolute disaster. Almost every one of our clients, many, are giving the money back. And where was that money supposed to go? It was supposed to go to employees. But owners had an obligation to their shareholders, a fiduciary obligation, and a lot of other things that drove them to have to furlough, obviously. But if they would have been able to keep that money, there's a lot of employees that would have been paid payroll that are not going to get paid now. And still, the government, even right now we have an extension, right, until May 14th to return the money. The government announced today that they're now sending out questionnaires to anybody who applied that you're going to have to fill out and certify under penalty of perjury that you indeed could not have had access to any other capital. You had no choice but to take this money. But that wasn't the point of the program. The point of the program was, we don't care. We know you're furloughing employees. Here's money to keep them employed. So I think the unions, the brands, and the government are all three constituents that we really have to focus on. And in my own little way, you know, I see American Hotel Lodging Association doing great things for our industry. And I think that it would really be great if everyone got behind, whether it's the American Hotel Lodging Association or whatever group or association it is, to help change and to help influence the decisions that are being made by those three constituents, because without them, we'll never get back to where we were.
Okay, I think we're running over. I'd like to say a huge, huge thank you. Each of our speakers, you guys have been fantastic. With the exception of Greg, who's a new friend. I've known each of you for 30 years and more. Thank you so very much to Greta Brooks, can't talk today, founder and CEO of Sales Boost. In closing, I just want to remind everybody that we are in the hospitality business, and let's conduct ourselves accordingly. Thank you so much for joining us today.
Thanks, Don.
Well
Bye,
said.
Thanks, everyone. Thanks, Greg.
Thank you.
Panel.
Thanks.
Thank you so much. Bye-bye.
And a couple of housekeeping notes as our panel final remarks. We are going to be sending out the recording of the webinar, and that will be sent out tomorrow to everyone who's registered. We appreciate everyone. Thank you, expert panel. And Dr. Wise, especially for leading this very engaging conversation. And Greta, thank you so much for your sponsorship of this important panel.
You know,
Absolutely.
I might make a suggestion based on Rick's closing comments. Maybe it'd be a good idea to schedule another one of these in a couple of weeks with all of us and address those topics in specifically, and maybe add to it somebody from one of the brands like Marriott or Hilton, because the brands definitely are already taking dramatic steps to help owners and to redefine some of the brand standards.
Very timely comment. We have a poll that we would love everyone to complete, but by already the comments that we received, it says yes, they would like to continue the series. So whether it's bi-weekly or monthly is the question, but it is certainly an important topic that our audience wants to continue to have that discussion. Nicely done. All right. Well, we invite you to participate in our other webinars as well. Sales Boost is continuing additional webinars for preparing for the rebound. And you can access that on our site. We'll send that information to you as well, in addition to the recording of the webinar today. So in closing, we want to say thank you once again for participating, for your comments, your questions, and especially to the panel. Thank you so much.
Thank you.
Bye-bye.
Bye.